This is a valuation analysis between Nvidia, AMD, and Intel. In this video, I'm going to look at valuation ratios, I'm going to look at fundamentals, I'm going to look at charts, and I'm going to look at the different business segments that these companies have to understand where that main revenue is coming from. So let's first look at the valuation ratios. And I don't like to start with P/E ratios because they are so easy to manipulate. I'm not saying that these companies are going to do that, but usually I always prefer my go-to ratio is always price to free cash flows, always. And I'm aware that many investors, they prioritize P/E ratios for some reasons. So I'm going to start with P/E ratios, even though I have to say that I don't really look at P/E ratios when I do valuation analysis. So if you look at Nvidia, currently investors are paying 40 times last year's earnings for the share price. For AMD, this ratio is 106. And the reason I'm laughing is because if I have a look at the momentum that AMD had over the past year, we can see that between a year ago and today, the share price is down 42%, whilst Nvidia is up 21%. That's significant. And even though Nvidia has increased in share price over the past year, it's cheaper on a price to earning basis. And I'm not going to look at Intel here because they have negative earnings. You probably know about the issues that the company has, and PE ratios doesn't. At least PE on a trailing 12 months basis doesn't really make sense. Now, on a forward PE ratio basis, it's quite interesting to see this because AMD is trading at 22 times next year's projected earnings. Yeah, whereas Nvidia is actually more expensive. It's 26 times. Hang on a second. Does this mean that AMD is going to overtake Nvidia in the next year? No. Let me be very clear. The street doesn't have a fucking clue on how to evaluate AMD's earnings. And why do I say this? Let's have a look. So, if I have a look at the comparison between AMD's PE ratio, on a trailing 12-month basis, and the forward PE ratio, that, just to be clear, the forward PE ratio is what Wall Street is expecting the company's PE ratio to be in 1 year, because they project earnings and they say, okay, if we continue at this price level next year, considering these earnings, the company will be trading at this amount. So the issue that I see is that if you look since 2022, the street has been projecting 20 times, so a forward P ratio of 20 times. The issue is that next year, the actual P ratio was 278. That's 10 times more. So the street got it wrong. And again, in 2023, the street projected a P ratio in 1 year of 44. And what was the actual ratio? 123. That's almost 3 times more. So the street is always anticipating a turnaround in AMD's share price, or in AMD, the company actually, and it's not happening. It's not happening, and that's the reason why I'm very cautious when I look at forward valuations, because they take into account these expectations, and usually these expectations are wrong and they don't happen, and there is no consequence for Wall Street if they are not invested into the company. So that's why I don't like PE ratios or forward PE ratios, but I just wanted to cover them because I know many of you guys are looking at this. Now, moving on a price to sales basis, we have Nvidia trading at 22 times last year's sales. And if you look at AMD or Intel, these companies look cheaper. Hang on a second, what's going on here? Well, what's going on is that Nvidia is very good at generating earnings. So it's very good at, generating revenue, but what it's even good at is from that revenue, that translates into net profits. Yeah. So in other words, the company has really good margins. So you have to ask yourself, what do you want? Do you want a company that is able to generate profits, or do you want a company that is very good at generating sales? Yeah. So I don't know which one you prefer, because I know profits. So let's have a look at the profitability metrics of these companies. And I'm going to start with Nvidia. this is insane. I mean, the company generated 130 billion last year, 130 billion. Take that number into try to make sense of that number, and the profit margin is 55%. So 55% of that revenue ended up as net earnings. That's crazy. And if we look at the free cash flow margin, which is the one I really like to look at, the margin is 46%. So 46% of revenue ended up as free cash flows. And the reason I'm surprised about these values is because AMD has a profit margin of 6.3% and a free cash flow margin of almost 10%. That's nothing compared to Nvidia. And if you look at Intel, I mean, this is disappointing. I mean, you probably know what's going on, with the foundry business dragging down the entire company. And you can see this here. Overall, they generated about 53 billion, which is significantly more than AMD, by the way. AMD generated only 25. So Intel is able to pull twice as much revenue. But when it comes to margins, it's horrible. So profit margin is negative 35 and free cash flow margin is negative 30%. That hurts. That hurts to see. So that was my point. Yeah. So if you look at sales, yes, Nvidia is not attractive, but what do you care about? Do you care about sales or do you care about profits? Because I know what I care about. So that's it. Let's move on to the next evaluation metric that I'm looking at. So price to free cash flows, and this is on a trailing 12-month basis. So you're currently paying 47 times Nvidia's share price, for the free cash flows that they generated in the past year. Whereas if you look at AMD, you're paying 71 times, and that's a significant, again, increase. Wall Street, one more time, is doubling down, and they say, no, this value is going to cool off next year to 25. And I call bullshit on that because they already missed it so many times, as you have seen before. In this chart, the disconnect between the forward PE ratio and the PE ratio was so big that I just don't really trust these forward metrics anymore. And I decided to include it because I know many investors they do look at this, but I just wanted to highlight that the street got it wrong, and that's why I'm not really confident when seeing this value, because over the past 3 to 4 years, it's been the same. Like, this value was significantly lower than the actual metric that was realized a year later. And of course, if you look at Intel, I mean, can you look at Intel? The reason is you can't, because they have negative free cash flows. In fact, if I have a look here, so this is just a quick summary of the free cash flow of the companies. Let's start first with AMD. They generate about 2.4 billion in free cash flows, and we've already seen that the margin is about 9%. Nvidia, 60 billion in free cash flows. That's crazy, at a margin of 46%. And Intel, and this was my point, is negative 15 billion in free cash flows, and you can see the margin is negative 30%. So if you look at a negative free cash flow, there are two reasons why this value can be negative. So either the company is burning cash in capex, or the company is burning cash in operations. And thankfully for Intel, the company is burning cash in capex. And from an operations perspective, they are not burning cash. So in fact, they are quite profitable when you only look at operating cash flow. But the issue we have here is the absolute insane amount of money, 24 billion in fiscal 2024 spent on capex. That's insane, because they generated 8.2 billion in operating cash flow. So that's why you have this huge, operating cash outflow in 2024. And look, I will be as direct as I can. I think that this foundry business is dragging the company down, and I will be honest, the reason why I don't think Intel is a buy right now is because there's a lot of uncertainty around this deal. You probably know March 12th, Taiwan Semiconductors pitched a joint venture, to Nvidia, AMD, and Broadcom, to take over Intel's foundry. And what is interesting about the joint venture is that Taiwan Semiconductors, of course, they're based in Taiwan, not in the States. You probably know what's going on with the new administration, and they're their efforts to bring back all that production, in the States. So they don't like foreign investors. And I like the fact that Taiwan Semiconductors, they said that they wouldn't take a stake more than 50% in the joint venture. Yeah, so that joint venture is going to be owned and mainly operated by American companies, which is great because that's aligned with the new administration. But these are just early stage talks, and I don't know what's going on with this. To be honest, I do believe that once Intel gets rid of that foundry business, great. That's the moment when I will probably go in with deep out of the money calls expiring in maybe 1-2 years. That will be a good time. But before that, I mean, you don't know how long this is going to be around or how long it will take. And I'm just not really happy with the negative price to cash flow ratio of the company. I'm just not happy. To be honest, I believe that owning Nvidia gives you more upside than owning Intel. And when Intel probably is going to divest that foundry, then maybe I would consider selling some Nvidia and using that to buy calls on Intel. But I just don't see the upside right now. Now, moving on to operating cash flow, as I said, Intel is profitable when it comes to this ratio because they don't burn money in operations, and they have a ratio of 12. It's more attractive, I have to say, than Nvidia's or Intel's. And again, if you're happy to pay 12 times last year's operating cash flow, great, but just take into account that if you want to do that, you're brushing under the carpet the fact that the company is burning 24 billion in capex per year. So if you're happy with this metric, it means that you're not taking into consideration the problems in the foundry business. And now if we look at debts, this is also one of the reasons why I don't really like Intel and that segment, is because net debt, again, just to clarify, yeah, so net debt is short-term debt plus long-term debt, and you subtract cash and equivalents. Yeah, so imagine that you have your short-term and long-term debt and you pay it right now with all your cash. So net debt is whatever is left. So Nvidia has a negative net debt of 33 billion. They have significantly more cash than debt, which is great. AMD, they're fine. They're 2 billion net debt, so negative 2 billion net debt, which means that they have more cash than debt. Amazing. Intel has 28 billion in net debt. Yeah, so when you look at the comparison between the net debt to EBITDA, we're talking about 3.7 times for Intel. And that's significant because it means that net debt is almost 4 times more than what the company generates in EBITDA in 1 year. So it will take about 4 years if they were to utilize absolutely everything, all the cash to pay debt. And then they will still have to do 4 more years of EBITDA and use all that EBITDA to pay debt, which is not going to be possible, of course. So that's my point. Intel is not really attractive, at least until they divest that foundry business. I don't think there is enough upside to own the stock before that happens, because God knows when that's going to happen. And when it comes to AMD and Nvidia, I will be honest, I believe Nvidia is significantly more attractive because Nvidia is focusing on profitability, whereas AMD, yes, it looks attractive on sales, but it's not attractive when it comes to earnings or free cash flows or operating cash flows. So that's my stance when it comes to valuation analysis. And now if I have a quick look at what's going on at each of these companies, it's not going to be a full analysis. By the way, I have a 1-hour analysis on Nvidia I did last week. Please have a look at it. It's a really good analysis, in my opinion. And I'm going to do the same for AMD and Intel in the next weeks. But if you want to have a quick look at what's going on, at AMD in this case. So we have the this is the Q4 and full year 2024 presentation. And what I wanted to highlight from this slide is the fact that, the data center segment, this is, I believe, one of the most important segments for AMD, for Nvidia. Intel not so much. You will understand in a moment why. So within the data center, there are two products that you have to look at. So from a CPU perspective, they have the AMD EPIC chips. I believe the fifth generation of the Turin is bound to be released by the second half of this year. And the next generation, which I forgot the name, it's an Italian city, you know, Turin, something with S. I'm sorry if I forgot the name. That's going to be released next year in 2026. The one that is quite interesting is the AMD Instinct, these chips, because these are GPU. Yeah, so these are for specific data center AI computation, and that's where the company is really trying to compete with Nvidia. Now they have a client segment with the AMD Ryzen, so these are consumer tablets, notebooks, laptops, and then they have a gaming segment as well. Of course, also an embedded segment where, you know, I believe they have some IoT devices, you know, where they put chips to these devices. And yeah, it's interesting, but when you look at, you know, the revenue per segment, data center is only 3.9 billion, and this is in Q4, you know, last year. And when you look at clients, 2.3, it's really close to that data center. There isn't, in fact, if you look at the percentage of total revenue per segment, 50% of revenue comes from data center and 30% comes from the client segment. So the company is highly exposed to this client segment, which, as you know, is very volatile and it varies very much with the economy. Back in 22, you can pretty much see, well, back then, I gotta say, well, let's look at the actual values, you know, for client. You see what I mean? So you can see in 22, the significant decline, yeah, particularly here in Q3, Q4. So yeah, you can see that it varies with the economy, and that's not a good segment to be exposed to. Data center is good, but yeah, not it's a small percentage when you compare it to Nvidia's. Now, if you look at Intel, we have the data center AI segment. What I like about these slides, I love it. They're transparent, and I like that. They have revenue, and they also show operating income and operating margins. Of course, they show their three main segments, even though they are, of course, if you look at the revenue per segment for Intel, we have the foundry, which is the number 2 segment by revenue, and they didn't include it in these top 3 segments. They actually left it for the next slide, you know, which is here. So that was a good move, and what you see here is that client computing is dominating revenues for Intel, and that's not good. For the same reason as I said before, you can see there when you had a high inflation at the back end of 2022, you can see this revenue being squeezed, and that's not what you want to see. You want to see, I believe it's more interesting to see data center revenue considering the surge in AI that's going on right now. So data center is 3.4 billion. That's nothing. As a matter of fact, AMD has surpassed Intel. I believe it was in Q3 last year. So something to consider there. And when you look at the price action for Intel, it's just sad, because 1 year shares are down 48%, and in 10 years, if you hold shares, if you bought shares in Intel 10 years ago, the return is negative 30%. So you invest 100 grand 10 years ago in 2015, and today you're at a loss of 30 grand. I don't know. And if you do this analysis for Nvidia, of course, it's impossible to know back in 2015 that Nvidia would blow up as much as it did. But yeah, over 10 years, Nvidia was a 20 bagger. So something to consider. And this is the main reason why I think Nvidia is dominating over these two other companies, is because of the data center segment. It's 88% of the entire revenue, and the 5-year compounded annual growth rate is 108%. This means that on average, the revenue in this segment has been doubling every year. Double. It's crazy. And when you look at the figures, I mean, things are even more impressive, because in Q4, we're talking about 35 billion in this segment. That's close to 10x AMD's data center revenue, and let alone Intel's. So yeah, this is I believe the main reason why I'm quite bullish on Nvidia. It's everybody's looking at it, everybody is paying attention at what's going on. Valuation ratios look very attractive, particularly after the sell-off. Year to date, I think they're down 20%. Amazing. So, is this a great moment to buy? I believe the answer is no. There is still some uncertainty with the tariffs. And of course, NVIDIA has a beta. I can actually check here to give you the actual value. So if you look here at the beta, it's 2.38 over the last 3 years. That means that if the S&P sells off by 10%, NVIDIA's down by 24%. That's not attractive, I gotta say. So I will wait until all this craziness with the tariffs ends, and then I believe when I see markets recovering, that's when I will go in. I don't know if whether I will go in with calls, but that's when I will go in full on Nvidia. Great. So that's it for this video. In the next ones, I believe I'm going to do a full analysis on AMD and Intel, as I've already done one for Nvidia. So thank you for watching, and I'll see you in the next one.